The financial market is always a harsh arena where profits go hand in hand with risks. And sometimes, just one decision, no matter how small, can spark a storm that leaves millions of people empty-handed. Let's analyze a painful lesson from such events. When the big guys strike, let's assume a typical scenario. A giant technology company, considered a pillar of the digital economy, announces a sudden strategic decision. It could be a change in its core business model, a withdrawal from a lucrative market, or even a shocking statement from a senior leader. Immediately, this information spreads at a dizzying speed across the media, social networks, and investment forums. Initially, there is skepticism, then a wave of massive sell-offs. The company's stock price plummets, dragging down an entire industry, even the entire market. Millions of retail investors who have invested in stocks, cryptocurrencies, or related funds have suddenly seen their assets evaporate. So what can we learn from financial earthquakes like this? What I want to tell you is never put your eggs in one basket. This is the golden rule of investing. Diversify your portfolio. Putting all your assets in one stock, one sector, or one investment channel, no matter how safe it seems, is extremely risky. When something goes wrong, you will have no way out. Allocate your capital to many different channels to minimize damage if one part of your portfolio has a problem. Herd psychology is a double-edged sword when the market is volatile. Herd psychology often takes over. Fear, when prices fall, and greed, when prices rise, can cause investors to make irrational decisions. Selling with the crowd or buying when prices are too high. The lesson is to stay grounded, do your research, and make decisions based on personal analysis, rather than following herd emotions. Information is power, but verified. In the age of information explosion, news can be a double-edged sword. And unverified news, a false rumor, can cause widespread panic. Always seek information from reliable, multidimensional sources, and take the time to analyze yourself before taking action. Risk management and stop loss. No one can accurately predict every market movement. Therefore, risk management is a vital factor. Before investing, determine the acceptable level of risk and set a stop loss. This helps you limit losses if the market goes against your prediction. Protecting your capital. Knowledge is a solid foundation. The financial market is not for lucky players. Successful investing requires extensive knowledge of economics, finance, market analysis, and risk management. Keep learning and updating your knowledge to be more confident in every decision. Lessons from market shocks always remind us that, no matter how much technology develops, the basic principles of investment and human psychology are always the deciding factors. Always be cautious, wise, and prepared for every scenario.